Active trading can be stressful, time-consuming, and still yield poor results. However, there are other options out there. Many investors might be looking for an investment strategy that is less demanding and time-consuming, or just a more passive investment style. But what if you want to invest in the markets but don't really know how to start? More specifically, what would be the optimal way to build a longer-term position? In this video, we will discuss an investing strategy known as DCA, or dollar cost averaging, which provides an easy way to mitigate some of the risk of entering a position. My name is Black Satoshi and welcome to my dojo, where I'm on a mission to reach 100 million Africans with the gospel of the blockchain and how it will change their lives. If you're new here, follow me, subscribe, like, share, and comment. If you're not, welcome back. And as usual, leave me a like and a comment. You can also sign up for the free Moneymaker Crypto Crash Course on the link in my bio. Okay, so what is dollar cost averaging? It's an investment strategy that aims to reduce the impact of volatility on the purchase of assets. It involves buying equal fiat amounts of the asset at regular intervals. Fiat is just cash. Ghana cedi, US dollar, pound, etc. It's cash. The premise is that by entering a market like this, the investment may not be as subject to volatility as if it were a lump sum, that is a single payment. How so? Well, buying at regular intervals can smooth out the average price. In the long term, such a strategy reduces the negative impact that a bad entry may have on your investment. Let's see how DCA works and why you might want to consider using it. The main benefit of dollar cost averaging is that it reduces the risk of making a bet at the wrong time. Market timing is among the hardest things to do when it comes to trading or investing. Often, even if the direction of a trade idea is correct, the timing might be off, which makes the entire trade incorrect. Dollar cost averaging helps to mitigate this risk. If you divide up your investment into smaller chunks, you will likely have a better results than if you were investing the same amount of money in one large chunk. Making a purchase that's poorly timed is surprisingly easy and it can lead to less than ideal results. What's more, you can eliminate some of the biases from your decision making once you commit to dollar cost averaging. The strategy will make the decisions for you. Dollar cost averaging, of course, doesn't completely mitigate the risk. The idea is only to smooth the entry into the market so that the risk of a bad timing is minimized. Dollar cost averaging absolutely will not guarantee you a successful investment. Other factors must be taken into consideration as well. As we've discussed, timing the market is extremely difficult. Even the biggest trading veterans struggle to accurately read the market at times. As such, if you have dollar cost average into a position, you might also need to consider your exit plan. That is, a trading strategy for getting out of the position. Like in all other forms of investment, it is essential to have a plan. And this includes at what point you want to take profit and leave the market or sell out to safeguard your initial investment. Now, if you've determined a target price or price range, this can be straightforward. You can again divide up your investment into equal chunks and start selling them once the market is closing in on the target. This way, you can mitigate the risk of not getting out at the right time. However, this is all completely up to your individual trading system. Some people adopt a buy and hold strategy, me for instance, where essentially the goal is to never sell as the purchased assets are expected to continue to appreciate over time. The purpose of a buy and hold strategy is to enter the market and stay in the position long enough so that the timing doesn't matter at the end of the day. Let's look at this strategy through an example. Let's say we've got a fixed dollar amount of $10,000 and we think it's a reasonable bet to invest in Bitcoin. We think that the price will likely range in the current zone and it's a favorable place to accumulate and build position using a DCA strategy. We could divide up the $10,000 into 100 chunks of $100. Each day, we're going to buy $100 worth of Bitcoin, no matter what the price. This way, we're going to spread out the entry to a period of about, say, 3 months. Now, let's demonstrate the flexibility of dollar cost averaging with a different game plan. Let's say Bitcoin has just entered a bear market and so it's going down. And we don't expect a prolonged bull trend for at least another 2 years. So we know that, yeah, the pricing will definitely go back up, but maybe over the next year or two. We do expect a bull trend to eventually happen and the price will go up, but we would like to prepare in advance for this. Should we use the same strategy? Probably not. This investment portfolio has a much larger time horizon. We would have to be prepared that this $10,000 will be allocated for this strategy for another few years. So what should we go for? We could divide the investment into 100 chunks at $100 again. However, this time we're going to buy $100 worth of Bitcoin each week. There are more or less 52 weeks in a year. So the entire strategy will execute a little less than 2 years. This way, we'll build up a long-term position while the downtrend runs the course. We're not going to miss the train when the uptrend starts, and we have also mitigated some of the risk of buying in a downtrend. But keep in mind that this strategy can be risky. We'll be buying in a downtrend after all. Okay, so for some investors, it could be better to wait until the end of the downtrend is confirmed and start entering. If they wait it out, the average cost or share price will probably be higher, but a lot of the downside risk is mitigated in return. These are my closing thoughts. Dollar cost averaging is a redeem strategy for entering into a position while minimizing the effects of volatility on the investment. It involves dividing up the investment into smaller chunks and buying at regular intervals. The main benefit of using this strategy is the following. Timing the market is difficult, and those who don't wish to actively keep track of the markets can still invest this way. However, according to some skeptics, dollar cost averaging can make some investors lose out on gains during the bull market. With that said, losing out on some gains isn't the end of the world. Dollar cost averaging still can be a convenient investment strategy for many. Most investors don't have a large chunk available to invest in one go. However, they may be able to invest small amounts over the long term. Dollar cost averaging can still be a suitable strategy in this case. Enough about what it is. Now, how to dollar cost average on Binance in 5 easy steps. So, step 1, choose your crypto and enable recurring buy. Log into your Binance account. If you don't already have a Binance account, sign up for one in the link in my bio. Tap on the credit or debit card option on the app homepage. Next, choose the crypto you would like to purchase and enable the recurring buy feature on the same page. For web users, simply tap on buy crypto on the top of the header and homepage and choose debit credit card. Step 2, select your preferred fiat currency. Choose from over 40 plus fiat currencies and pick your preferred local currency. Step 3, set up the frequency with which you would want to purchase. Tap on the date on the same page and choose between weekly, bi-weekly or monthly intervals. You can also select the day and time for your recurring buy. Step 4, select your payment methods. Binance currently accepts Visa and MasterCard payments only. You can choose to use one of the existing cards or add a new card. These payment methods are just for the recurring buy. Step 5, confirm your order details. Check and confirm your order details in 1 minute. As after 1 minute, the price and the amount of the crypto you will get will be recalculated. After you can confirm your order details, you're done. Although a more long-term strategy, taking regular small and incremental steps in your crypto investment through the use of recurring buy can add up to your portfolio, having bigger gains over time. With that said, make sure you carefully consider your financial goals, risk appetite, comfort with trading before considering setting up recurring buy. Make sure to do your own research before committing. As you well know, I'm not a financial advisor and this is for the purposes of education only. Also, I have a free 7-day Make Money Crypto Crash course on my website. You can sign up through the link in my bio. More than 150 people in the community have already benefited from it, and you could too.